Welcome, guys, to the Traders Desk. It's the 16th March of 2025. Lots happening in the markets. Before we get started, this is not financial advice. This is purely for educational basis. Do read the disclaimer. Also, all the material presented here is copyrighted and owned by the Financial Traders Hub. So let's start off with some notable charts. We've got the RSP on the left, which is basically the equal weighted version of the S&P 500. So what information would you take out of this? As with the rest of the broader market indices, it's also down. However, it's still not managed to close above the 200-day moving average. So that's something we need to keep watching because there could be a major sign of weakness if this keeps going lower. So basically, when the RSP is going down, it's telling us that the sell-off is not just restricted to the Magnificent Seven. So it's across the board in the S&P 500. So that's something to keep watching because ultimately the price or stock prices are reflective of the future expectations of earnings in all these different companies. And if we're looking at the top 500 companies in the S&P, and by extension, the share prices or the average of all the share prices, which is reflected by the RSP, is indicative of their future earnings. That gives us a very good read on what the market is thinking about in terms of the economy in the US. So keep looking at this. Very interesting. Gives you a lot of insights. On the right, we've got the Magnificent Seven. So it's managed to pull a recovery in the last week, predominantly on Friday. So it's closed above its 200-day moving average. I still think there's a lot of weakness here. So expect a bit of volatility and maybe this to go down further as the market keeps deleveraging. There's also been a lot of, I mean, if you were to plot the US broader market indices against, let's say, the European or any emerging markets, you'd see that the US has significantly underperformed. So a lot of money has moved out of the US going to Europe and Asia and some emerging markets like Brazil, Turkey. You can pull up the Turkey MSCI ETF and you'll see that it's actually breaking it's on a breakout. So it's moved above the 200-day moving average, almost like making a new high in recent months. So that's indicative of how capital has been flowing. You can also look at the EEM and a lot of these other emerging market indices. A large part of it is also because of the US dollar falling in value over the last few weeks or even months. And that's supportive of foreign equities. On the left, we've got the momentum in ETF. So this is basically a collection of stocks that are highly momentum driven. So we can see that the sell-off, these stocks were significantly affected. And the rally that we got on Friday, which is showing up as a recovery on the week here, has been predominantly in the momentum or highly momentum driven names. So these would be like your high PEs, your Nvidia, um, a lot of these other high momentum driven stocks, right? The meme names and all of these. So think about it. The recovery in the stock market is being led by highly momentum driven names. Is this a recovery or is this basically shorts taking profits or shorts now getting squeezed as there's a bit of a relief rally? We all know when markets fall, when there is a sell-off, we're also highly vulnerable to what we call bear rallies or relief rallies. And a lot of that is driven by shorts covering and shorts getting squeezed. The reason we need to make this distinction or attempt to find an answer that's closer to the truth here is because it paves the way for the future of stock prices. A lot of times in individual names, you would have seen me say with high level of conviction that, you know, the rally on earnings, for example, is probably short short covering related, and then in the next couple of weeks you see that the stock price just collapses back down and makes new lows. The reason we need to find an answer that's closest to the truth here is because if the buying is not on fundamental basis, the stock prices will eventually just get back down and close, close even lower. So that's the reason why I say do not seek validation from daily price movements or price action, because a lot of these price actions, especially when the volatility index is high, it's predominantly from short-term traders changing their positioning in the market, whether that's to take profits or to get even more short in the market. So nothing related to fundamentals on a long-term basis, right? And at the same time, what you would have is the longer term participants who are probably thinking now they need to move money overseas, or they are probably looking at economic projections in the US and thinking the prospects are not looking great here. And they are maybe cutting their exposures in terms of longs or re-underwriting a lot of their holdings. So as they move the bias in their portfolio from net long US to maybe neutral or even underweight, then stock prices will also change accordingly because they are making trading decisions in between. On the right, we've got the US oil, so basically WTI crude oil price. So this is basically still holding to this multi-month or multi-year support line. And we thought last week that we got a break below, but it's probably now gone back to that line and just, hugging that support line as much as possible. So we're still waiting for a conclusive move here. The reason we are looking at WTI crude oil is because this in itself will have a huge bearing on what future inflation would look like in the US. And as you know, monetary policy and everything else is related to the level of inflation in the US. So keep an eye on this. I think it will eventually break down below. It's got very weak price action. And also, if the US economy is slowing down, and at the same time, maybe a couple of the larger economies in the world are also slowing down in China, India, and some parts of Europe as well, I think the demand for oil might not be as much as projected. So just a small deficit, just a small surplus of oil, as in the world is producing more oil than what is being consumed, will cause the prices to fall quite significantly. So keep in mind that another thing, the crude oil price has come down at the same time as the dollar has been coming down. So typically these are inversely correlated, which means that if everything else is the same, if the dollar goes up, then you would expect the price of oil to fall. So in this case, what's happened is the dollar has gone down quite significantly, and oil has also gone down quite significantly, right? So what would the price of oil be if the price of dollar was held constant? It would have been even lower, right? So the not the price, but the change in price would have been even lower. So that's indicative of significant weakness being priced in by the market. However, at the same time, we've also got some hostilities in the Middle East, the hostilities in Russia and Ukraine, which are far from being resolved. I think that's not what the market thinks. The market thinks that uh, we are much closer to seeing a solution than ever. I think we are closer, but not much closer. Because if you look at the conditions that Putin has put for the ceasefire, it's literally, if you were to translate it, it's basically all the conditions that he wanted from the outset, plus at the same time, he wants Ukraine to accept defeat and at the same time retain some of the territories that they've acquired during the war, right? So That's a very tough place to be for Ukraine because, you know, for them to agree to these conditions for a ceasefire is it's a little bit of a humiliation. I think little is probably an understatement here. But at the same time, as Donald Trump says, Ukraine doesn't have the cards, right? So they have an army that's been fighting quite bravely, but the arms, the intelligence, are coming from the US or NATO. And if the US decides to pull away from that, then Ukraine has probably got very low chances of being able to continue this war and hold the enemy back, if that makes sense. Um, I think all of this is probably more of a distraction than anything. Of course, it affects sentiment in the financial markets. But if you think about it, this war in Ukraine and Russia has been going on for years now, and it's not necessarily having any bearing on the financial markets in the US at the time we were speaking. So that being resolved, it's great for the world. It resolves a very difficult situation. On a humanitarian basis, it's amazing as well because so many people, will not be killed, and hopefully Ukraine gets the chance to reconstruct. And from here onwards, there's a brighter future for Russia and for Ukraine and for that part of the world. But when it comes to US markets, for the last few years, they've been functioning relatively well in spite of all this hostility. So that's something to keep in mind. You'll see a lot of headlines that might affect sentiment. But as these headlines, the nature of headlines is that they are transient. They come, they get everyone, to think one way or the other, get everyone to become passionate, and then the next day there's a new headline. So keep that in mind. If you're trading solely on the basis of a ceasefire or something like that, I think it's time, for you to rethink your strategy here. Then moving on to the US 10-year. So this is an indication of what long-term rates are doing in the US. In the last 2 weeks, we've seen a little bit of a bounce from the lows. So looking at this, one could say that the 200-day moving average is holding up, which is not great for equities because it puts a lot of pressure on equities because this is reflective of borrowing cost as well, right? At the same time, it's also indicative of a market where inflation is still an issue. So there's a little bit of a tussle happening between growth expectations and inflation expectations. And as we'll see in the presentation later, I'll speak a little bit on inflation. And, that's going to give us a better understanding of how to think about this whole thing as we are navigating. The most important thing here is not to be the one who's calling inflation is under control or out of control. It's to understand what the market is focused on. And then as time progresses and we get more data, we understand whether that's validating the market's positioning and views, or whether the data is moving against what the market's views and positioning were, right? So this is basically what I call the status quo. We don't have the answers for the future. We can only be prepared by understanding what the status quo is like and then evaluating if the incoming data is confirming the status quo or disproving it. Because either way, you'll see capital flows. Then finally, we've got the USD Japanese yen. So not much of an exciting week for this currency pair, but you can see the trend is down. It's broken the 200-day moving average. And I would not be surprised to see another few weeks of this going much lower and retesting the lows of 140. Obviously, this is not going to happen in one day. And if it happens, let's say on Monday, I'm sure Hans would remind me of the crystal ball myth. But I think this is probably where this is gonna go. So keep that in mind because this has a lot of bearing on risk sentiment in the US equity, predominantly in the tech space, where it's at a risk of a carry trade unwind. As we've been discussing, a lot of people have been borrowing in yen to invest in the US, and that's predominantly gone into the tech space. So your Nvidias, Microsoft, Google, Tesla, all these tech companies. Oh, we've got two more. So I've got two indices here. So not indices, but ETFs. The one on the left, which is the LQD. This is the investment grade corporate bond ETF. So we discussed this last week. The reason we are looking at this is to get an understanding of whether the bond market or the corporate bond market, which tends to be more professionals than retail investors, we want to understand how they are perceiving all these economic shifts and whether that's inflation, tariffs, growth expectations being revised downwards, and so on. So we want to see how the bond market thinks about this, whether they are actually experiencing what we call credit spread widening, which would manifest itself in a fall in these ETF prices. So at the moment, there's not much conclusive evidence, to hint that the corporate bond market is scared or panicked. If anything, what we've been seeing from January till now is quite a few new issuance, which means that the capital markets remain open for high yield. In this case, I'm looking at investment grade, which is a few notches higher than high yield bonds. But when we even look at the lower quality bonds, we've been seeing companies being able to raise capital fairly easily at relatively attractive terms without credit spread widening. So from January till now, we haven't really seen much of an issue being indicated by the corporate bond market. But in the last 2 weeks, what we've seen is that these indices have come down quite a bit, not as much as equities, and now they are both kind of hinging on the 200-day moving average. And the same can be seen whenever we look at the credit spreads themselves. We'll see that it's ticked up as we've seen in the last 2 weeks. So if we pull up this chart from Coifin, we should be able to see exactly the same trend. Actually, let's try doing that as we are on this topic. So the reason I also look at the corporate bond market is because not only it's more investment professionals dealing in that market, but at the same time, this is something that will push the Fed to really move towards cutting interest rates, because the bond market is a lot more important than equities for the Fed. So I'm looking at the credit spread amongst the high yield segment. So if we look at the last, let's say 6 months, actually we could look at, yeah, I think 3 years is good enough, right? Or even 5 years. So this is around the COVID period where, actually let's look at 10. So this is around the COVID period where there was a lot of uncertainty about the default and bankruptcy risk of a lot of corporates as we got into lockdown. And then that was very quickly resolved with the Fed coming and stimulating. So as these spreads were going up, it was near certain that the Fed would do something, because for the Fed, if the capital markets are frozen, that's a big problem. And that predominantly happens in the bond market. And that's why the Fed looks at the bond market and it would act very swiftly. So if you recall in March 2020, the Fed came out and they said that they even have plans to start buying the LQD, which is basically the chart over here, right? So the investment grade corporate bond ETFs. So that's quite a statement. And they actually did not do any purchases per se, but the market recovered just on that statement. The Fed said they were prepared to start doing corporate bond purchases. So that's the reason why I like to keep an eye on these spreads, because as these come up, equities will sell off. So one needs to be very mindful of this. These spreads have not come down, as we've seen a recovery, supposedly like a relief rally in equities, but these spreads have not come down. So keep an eye on this. If this keeps going up, going higher, and at the same time you will see that these ETFs start to break down to the downside, right? As these start breaking, then you should know that the corporate bond markets are also now pricing in more risk, which in a sense would happen because the economic growth prospects of the US is going lower. Um, a lot of companies that are in the high yield segment would tend to be oil and gas companies. So as the price of oil falls further, these companies will have more pressures on their cash flows. And by definition, this would make the bonds a little bit more risky. So these bonds would also move lower. And if you have a large portion of the oil and gas companies in the HYG, you would expect that index or that ETF to come down in price. So there's all of these moving parts, but for your purposes, just look at these indices. If you see a major break below this 200-day moving average, then you should know that the market has changed and now it's been concerned about new things. So that would be conducive towards an environment where the US equity markets will sell off even more. I've got this, which I was looking at earlier today. Found it quite interesting. So this is basically from FactSet. It's a company that basically gives us a little bit of high level insight in terms of sectors and how earnings and revenues expectations are falling in line or missing estimates. So what we've got here is for Q4 2024. So what we can see is predominantly wherever it's green, it means that companies have reported earnings above estimates. Wherever it's red, it means that companies have reported earnings below estimates, so they've missed. And then wherever it's yellow, it means that they've reported in line with estimates. So in Q4, what we could see is that most companies, and remember, Q4 is the earnings quarter that's just gone, right? It's not Q4 calendar year, but it's Q4 financial year for companies, which typically tends to be Q1 2025, right? So these are companies that have already reported. And what we've seen is we can see more green than red, right? That's evident. But how could you use this information? You can look at these different sectors and see where you're starting to see more red than green, right? So, for instance, it's not difficult to work out that, the sectors like real estate, utilities, materials, they have more risk going forward of missing estimates than beating estimates, right? Predominantly real estate and utilities. And if you look at the chart at the bottom, this is basically on the revenue front now. So percentage of companies that have reported above estimates, that's indicated by green. And red is percentage of companies that have reported revenue below estimates, right? So you can clearly see that this, as you go, let's say from even, yeah, I mean, let's say from real estate all the way down here, you can see that revenues of these companies are finding it more difficult to beat revenue estimates, right? And that was in Q4. So basically, if you had to sum up the recent earnings period, this is basically what you would find at a high level. And then you can drill down these individual sectors and find companies that you think might have issues, or even companies that might keep beating revenue estimates and therefore EPS estimates too. So that's a good way to get an understanding of actually what's happening within all these industries, and then drill down to look towards the future to find more interesting ideas, whether it's long or shorts. Any questions here? Okay, don't think there's any question. So this is a bit more interesting. So this is basically related to guidance. So what we've looked before that was the actuals, so reported numbers versus estimates. What we're looking at now is guidance for the next quarter, right? So share prices are going to move related to what's going to happen in the future. So if companies are raising guidance, then share prices would tend to move in line with that, right? So what do these graphs show us? So this is basically the top one is showing us the number of S&P 500 companies that have positive and negative guidance. So basically, the green is the green bar chart is basically indicating the number of companies within that sector that have raised guidance compared to last quarter, and red is number of companies that have reduced their guidance compared to previous quarters. So you can see that there is a little bit of trouble brewing in the IT sector, right? And if you see that tech has been recently undergoing a sell-off, and you match it with what you're seeing here at a higher level, that should not be a big surprise, right? If you look at the other industries, other sectors, you still have a few sectors where, like for instance, in industrials and healthcare, consumer discretionary, you see the number of companies that are actually downgrading guidance is far more than the number of companies that are increasing guidance, right? So of course, you don't see all the companies in the S&P 500 because not all of them are featured here. Some of them might not have reported yet too. This report is dated 14th of March. So it's the most recent that we've got. And I think it's released every Friday, if I'm not mistaken. And it's released by FactSet. It's fairly easy to find with Google. And at the bottom, what we've got is the percentage of S&P 500 companies with Q1 positive and negative guidance. So the same thing, just expressed as a percentage. Um, right. So this is one thing I wanted to show you. So this basically indicates how the expectations for earnings growth for Q1 2025 have changed from the 31st of December. So basically, as we are coming into 2025, everyone's bullish, everyone's buying equities. And what are these expectations like basically as at Friday, right? So look at the discrepancy here, right? If you look at, let's say, let's pick one sector. Let's look at healthcare itself. So starting 2025, 40%. Yeah, so this is basically S&P earnings. Yeah, so 40% of companies were expected to have earnings growth. No, sorry, this is S&P 500 earnings growth. Okay, so at the sector level, they were expecting 40% increase in EPS, and as of Friday, that number has gone down to 35.5. It's not a massive drop, but it is a drop. It's basically showing you that expectations are getting reduced, right? And if you look at, let's say, a sector that's stressed like materials or energy, I think materials is the worst here because coming into the year, they were expecting 7.2% earnings growth. And basically, what as of Friday, what we are seeing here is minus 10.3%, which is a massive variance from the 7.2 figure, right? So that's like a 17% swing, right? If you look at energy, coming into the year, they were expecting minus 9.4. It's gotten worse. It's now minus 12.3. It's just 3% of a swing, right? So these expectations move share prices, right? And that's the reason why we need to be able to understand these at a high level. So we've got this for both the earnings growth and revenue growth. I like to look at revenue growth too, because revenue, if revenue is not growing, then it's very difficult to get earnings growth. You can have stable revenue growth, stable or flat revenue for a couple of quarters and still be able to grow earnings, but that situation is never sustainable. It's very difficult to keep growing earnings without having revenue growth. So here too, we'll take the same approach. Wherever we are looking, let's say we are looking for shorts, right? So we'll definitely want a sector which is seeing downwards revision in terms of revenue growth. Let's pick one sector. Let's say consumer discretionary. Going into 2025, at a sector level, they were expecting 6.3% growth in revenue. Now that number has gone down to 3%. I think that's dire. I mean, put that into perspective with all the consumer sentiment falling, all the news around consumer spending being negative. For revenue to fall from 6 to 3%, I think that's quite bad, right? And you also have a reading for the S&P itself. So revenue estimates have gone from 6.3%, sorry, from 5.1% to 4.2%. So the reason why you see the S&P falling is not just because of tariffs and all of this. It's also because earnings or revenue estimates are being cut down, right? It's very important to realize this. The share prices always reflect future expectations of earnings. Okay? Based on what you've seen here, do you see that there could be more room for the market to go lower? If not at a market level, but at sector level, do you see that there could be further downside?
Yes, I think so. I think like for me, even the consumer staples are
Mm.
showing
Yeah,
like like much more discrepancy.
yeah,
There most of the capital is moving,
yeah.
so
And
there's more disappointment there.
to be short consumer staples here, uh, it's actually not a bad trade if you can find one company that has had its valuations gone up far too much just because everyone is, you know, crowding the consumer staple space. Because eventually, when the fundamentals come forth, and at the same time, maybe you have a risk on rally, right? These two factors in themselves can cause the share price to come down quite a bit, right? So I think I've referred to this before where hedge funds find these companies and they go hide in these companies, then that pushes the share prices much higher. And at some point, you're like, how can a consumer staple company that's growing at 3% revenue, growing earnings maybe 5%, be valued 20, 25, 30 times, forward earnings? Then that becomes a very good and very interesting short idea. One such idea that I had played probably 2 years ago was Hershey's. So it's a company that manufactures chocolate powder, right? You can add that to milk and chocolate sauce and all of this nonsense. So that company eventually became like a hedge fund hotel, which is basically my way of saying that all the hedge funds are using it to hide. And then as the risk on move happens, everyone's moving out of consumer staples, then that company just falls for like months. I think there wasn't one month where it had not fallen, or even, multiple consecutive weeks of it just going down because everyone's just selling the stock. So think about these things in that way. You have to be clever. You have to be very tactical in terms of how you think about trade idea generation. It's not just, you know, fundamentals. It's not just technicals. It's not just positioning. It's a mix of all of this, and you have to be understanding of this, right? There's a lot of uh, qualitative, quantitative, but also contextual information that you have to use and overlay, and then you'll be able to get a good trade idea out of, because the whole market is looking at the same information, right? The numbers you're seeing here are not going to move the market. It's the one that probably will come out in the next couple of weeks that will move the market one way or the other. And by the time it's out, everyone already knows it. This is basically for us to put moves into perspective and to understand what's happening at a sector level. It's not for us to look at this and say, okay, I want to go long or short XLP, which is consumer staples. That's not what it's meant for because this is backwards looking information. Is that clear?
Yeah, it's clear.
So,
Roshan, can I make like one more point?
yeah, absolutely.
Uh, so is it fair to say that if you're expecting consumer staples earnings to come down,
Hmm.
uh, or maybe even your expectation on your revenues to come down,
Yeah,
so that means there's more room for consumer discretionary to come down even further.
yeah, absolutely.
Uh,
It, it's uh, it's not necessarily related, right? Um, a lot of like, I'll give you an example. Consumer staples used to be companies like, let's say, Dollar Tree, right? Where you would walk in and then you can buy anything at $1. But inflation has just made this model redundant. It's like irrelevant now because you cannot buy anything for $1, right? So that company in itself has 10 years ago in the past cycles, it used to be the darling of the market, right? Whenever there were consumer spending issues on the discretionary front, they would go to that kind of a company to hide, right? Because people would kind of downgrade and start buying from these dollar stores as their pockets were being pinched, right? But what we are seeing here is a big shift in consumer sentiment, and that affects consumer staples, consumer discretionary as well. Because remember, even companies like, let's say, a company that produces chocolate sauce, right? If you're really stretched in terms of your budget, you can always find a cheaper alternative, right? You're not gonna be looking at, I really need Hershey's itself and all of this. You will find that a lot of people will find substitutes or actually not buy it. And as we are seeing, the consumer sentiment is not hitting. I mean, always seen this. It doesn't hit everyone equally. It's normally more pronounced amongst the lower and mid income segments. So these are the people who are buying a lot of these products, right? And you would have seen from the earnings from Costco, Walmart, these companies are indicating that the future is quite bleak, right? They haven't raised guidance. If anything, they've downgraded future outlook. So all of this put together is already telling you that the consumer is stressed and probably not doesn't have a high propensity to spend. Yeah, does that make sense?
yes, Roshan. Yes.
Okay, let me carry on. Okay, go ahead, Darren, if you have a burning question.
Yeah, I do. Can you go back on the last graph, please?
Yeah.
And looking at the revenue growth and earnings growth,
Mm-hmm.
it looks like we are in a really dire situation with like all the readjustment.
Mm.
done. And I just wanted to ask you, why don't we see the same like Daya just met in the ISM report? Like I would have maybe expected
Mm-hmm.
the ratio to be like below 50%,
Uh,
right? Like contracting in terms
Look,
of new
it's
orders. Yeah.
the ISM report is not massively expansionary. I
Mhm.
I'm not remembering what number the index
I think
came out
yeah.
at. I think it
I
was
think it was at
slightly above 50, 50
yeah, I
point
think it was
something.
50.3. Yeah.
Yeah. So that's
Mhm.
like borderline, right?
Mhm.
Um, New orders was contractionary from what I remember. It was 47, 48 something. Um, so you are seeing it, and it's even scarier because the ISM is the what we are seeing here is okay. You could say it's reflective of the next 2, 3 months, right?
Mhm.
The ISM is probably a bit more, you know, long term in terms of its predictions,
Mhm.
and
Okay.
that's it's a little bit like you have high frequency curves and shorter frequency curves kind of merging together now, right? It takes a little
Mhm.
bit of time, but they are now all collapsing together. And that's probably what the market is also scared about. When we talk about GDP growth slowdown and all, I think it's not coming out of thin air. I think as we were starting 2025, none of us were as expecting that ISM new orders would be going below 50, right? It
Mhm.
was trending up and it was kind of in expansionary territory, and we were all quite happy about it. And then the last month was just a break from the trend of recovery.
Mhm. And
So
just based on the graph, yeah,
yeah,
I see materials to be in really bad shape.
yeah, yeah, yeah,
Uh,
yeah,
I think they were predicting like 7.2% growth and
yeah,
now 10.3 like
yeah.
contraction. So
So
mhm.
what would you guys consider as materials? You can all participate, eh? Just throw in an idea of what would fall within materials sector.
Chemicals.
Yeah, chemicals, yeah. You've all seen what's happening in chemicals, right?
Yep.
Companies like SHW, PPG, um, they haven't done well, especially December onwards. Materials will also be, like wood,
Mhm.
steel, um, everything else that's used in building materials and so on. And if you look deeper within the chemical segment, I can show you a few names. It's it's not looking good. So let me check this. I haven't looked at this company in a long time. So APD, this is a company that manufactures industrial gases. So basically like pure oxygen that's used for welding and for industrial processes. You can see the big drop here, right? Um, this is another company. This is mostly like chemicals, right? These two are chemicals. Um, look at this. This is absolute chaos, right? So this company manufactures polymers, if I'm not mistaken. So these all these chemical polymers that are used in plastics and engineered material businesses and so on. Basically, what this is telling you is this is the feedstock for other industrial processes, right? Uh, let's say polymers are going towards manufacture of plastics or textiles. So if demand is coming down there, obviously they're not going to be ordering more feedstock from these guys. And you can see this in the share price, right? You don't necessarily have to go and look into the earnings report to understand what's going on here. It's not a pleasant situation. You can see that. Let's look at XLB, right? XLB is basically materials ETF, right? So what you could do is if you could go to Coifin and then just look at the holdings. Send it a chat. The new order for plastic and rubber is down. Yeah, quite possibly. Okay, so let's look at the materials ETF. What's the constituent and what they've been trading like? Okay, this is very interesting. There's only two company, or actually three company on a actually two companies, right? On a monthly basis that are up, that have performed more than 0%. All of the others are just negative, right? So on a monthly basis, the whole material segment has just been selling off. So, okay, what do these companies do? So this one manufactures fertilizers. This one manufactures gold. It produces gold. This one, I forget exactly what it does. Let's just take a quick look. This one produces copper. This one, I think it's a chemicals producer. Dow is another chemicals producer. PPG produces paint. Same for SHW. Nucor, I think, I'm forgetting now. What does it do? Let's check quickly. So this is material science. Okay, what is this exactly? Yeah, it looks like engineered plastics. So basically things you'd use for fingerprinting and so on. Let's look at this one. This is another chemicals company. So this manufactures, okay, chemicals like olefins, co-products. A lot of these are used in textile and other industrial processes, oxyfuels and so on. So some of these plastics polymers are used in car manufacturing. And as we know, there's a lot of chaos within the US car manufacturing space. So that's creating a lot of issues down the value chain, right? So a lot of times when you read a piece of news, and it's indicating that maybe, let's say, the car production will go down, the first instinct is always to short the car manufacturers. But if you think through things, you can always go down the value chain and find the second order effect of that news headline. If car manufacturers are going to be manufacturing fewer cars, who gets hit? It's the steel plants, it's the polymer manufacturers, the guy who sells semiconductors that are used in car manufacturing, right? Because a lot of times these companies are highly concentrated towards these end industries. Does that make sense? So now that you've seen this, I have another question. So a lot of these companies, they seem to be supplying feedstock to industrial manufacturing, right?
Correct.
So if these companies are going lower, what could that mean? Is the US manufacturing industry healthy? Is it ordering more, or are we seeing a little bit of issue down the value chain here?
It just screams issues for me
Yeah,
all over.
it's
Yeah.
it's quite concerning, right?
Mhm.
Let me show you something else. And you know, these are the techniques you have to also develop. Oh, don't do exactly the same thing that I'm doing. Develop your own ways of looking at things, because at the end of the day, this game is about search of the truth, right? So this is the XLB index. Do you see that it's been able to rise above the 200-day moving average? No. It broke down first here, attempted a rebound, tried to recover above this, got denied. where do you think it's going next?
Going down further.
Right? So if you needed to make money, what would you do here? If you
Just
shorted this,
closing. Yeah.
if you shorted the XLB, I think you could make money with a high level of probability, with a high probability, right?
Mhm.
You short it at 86, it's probably gonna go back to 83 and maybe even lower, right? But I'm not suggesting you should do that. All I'm saying is a lot of times these things are very, very obvious. It's staring at you. But then you're wasting your time on social media, on YouTube, listening to 150-year-old veterans of the stock market speaking on YouTube from a basement, right? And meanwhile, these things are sending flashing signals to you, and you're not able to generate trade ideas from these, right? It's not a laughing matter, Bhavan. What I'm trying to say here is a lot of times it's a lot easier than what you think it is. And the market is telling you it's a short, it's a short, it's a short. What are you waiting for? It's a short, right? The pros would actually start shorting it around here. But even if you short it here, right? Like no one's gonna tell you you're not, you haven't caught this, right? You're still gonna make a lot of money. And of course, we're not gonna go short the XLB, right? We're going to go into the constituents, find actual trade ideas, and then put them on and make 15, 20, 30% in the next 3, 4, 5, 6, 8 weeks. And if you do it with options, it's just beautiful, right? So we got to this just from looking at this chart, right? And this is publicly available information. So a lot of times it's probably also good for you to maybe as you're rewatching this video, just sit down with a diary or notebook and just make a note of all these sources, right? Whether it's FactSet, a few others that I've got in the presentation, because these are very good information sources that are regularly updated, and you can get a lot of insights from that, right? So, this is a little bit why I'm always scratching my head when I'm posting all these things on the ISM, and then I see nothing being worked on by the group, right? Because to me, it's like, am I speaking Chinese and no one's following? Because this is like very obvious, right? A lot of these statements, a lot of these, the heat map that we normally share in the Discord server, a lot of these are giving you tremendous ideas, but you just don't want to go and do your own work. Instead, I think sometimes what people are also looking for is like a sure idea or trying to become like a hero on a particular trade. Just make money, right? That's enough. We don't ask for more. If you want to be a hero and all, that's fine. Do it on the 10th trade, right? Have 9 other trades in your portfolio. Then for the 10th one, you decide to become a hero and, go out of the money and find like the sexiest trade out there. That's fine. But if you cannot get the bread and butter trades in your portfolio, you're very far from being a hero. That's basically what I'm trying to say. Is that making sense?
Yes, sir.
So, you know, th- this is basically my message, right? A lot of these things are staring at you, and these stocks are wondering why you're not shorting them. Anyway, let's not spend further time on this. Do we have any further questions, or can I move on? Okay, I'll move on. Okay, so US consumer confidence drops. I think this merits significant bandwidth. We had this report that I'm looking at. It's the Conference Board Consumer Confidence Index. So this came out on the 25th of February. It's been a while since it's out. But then on Friday, we've also gotten an update of the University of Michigan Consumer Sentiment Report. Very bad numbers, right? So I wanted to run you through this one because there's a bit of qualitative information that would allow you to get a little bit more context in terms of where the sentiment change is happening. So from my reading here, if you look at the red highlighted segments, there are quite some telling statements. So for the first time since June 2024, the expectations index was below the threshold of 80 that usually signals a recession ahead. So it's not just the current conditions index that's going down. People are more worried about the future, right? And you can see why the share prices are also acting in the same manner. The second segment, this is the third consecutive month-on-month decline, bringing the index to the bottom of the range. So this is not a one-off, right? We've been following this, we know about this. Views of current labor market conditions weakened. So the job market has kind of held up, but the future outlook of labor conditions is weaker, right? So if in the next couple of months you see that the job market is weakening, it shouldn't come as a surprise, right? You've been warned, right? And the people who participate in these surveys are the guys who are working in these different companies. So they will have a view of whether it's getting tighter or not in terms of the labor market, whether they're getting more offers, fewer offers, whether they are at a threat of losing their jobs, whether they've heard someone from the neighborhood at a party or something that's recently lost their jobs, right? So all of this kind of, let's call it collective intelligence, is getting is getting it's making its way in these reports. So obviously we're gonna go and speak to each and every individual in the US, but these reports are the best in terms of giving us the high level insights. Consumers became pessimistic about future business conditions and less optimistic about future income, right? So who's going to buy a new car, right? Who's going to buy a fourth car for for their kids? They're going to hold on a lot of these, hold off a lot of these discretionary purchases, right? Who's going to get a new boat? Who's going to get, a new house and all of this? It's going to get more difficult. Pessimism about future employment prospects worsened and reached a 10-month high. We've discussed this just now, right? So the guys in the US who are responsible for around, what was it, 70% of US GDP, basically the US consumers, if you could get into their heads, this is basically what's happening. There's a complete sentiment change, right? So would you be surprised if in 3 months' time, consumer discretionary companies are basically just disappointing on estimates and revising guidance lower? Would that be a surprise? Would it be a surprise if CarMax says, oh, by the way, we haven't sold as many cars as we thought? If, let's say a company, like let's say Disney, if Disney comes out and says, oh, by the way, the turnout at our parks has been lackluster, much lower than what we estimated, so we're going to cut guidance, it wouldn't be a surprise, right? And your job is to basically be positioned for these. And as they are announcing these, dire circumstances, it's for you to be closing your trades because the market would be trading much lower at that point in time. That's basically the job of a trader. It's to see the future position for it, and then when it happens, just take profits. This is quite interesting. So all this sentiment or confidence fall is happening across ages between 35 and 55. So these are the working class active population. The decline was also broad-based amongst income groups. So I think I was mentioning this to Amin yesterday on the Discord server. When we had the first fall in consumer sentiment a few years ago, there was a dichotomy in that the sentiment change was more pronounced and more dire towards the lower income segments. And people who were at the mid and high income segments were least impacted, if anything, right? These guys were still consuming the same way they were buying luxury goods, cars, housing, no questions asked. Now it's a difference, totally different, with the only exceptions amongst household earning less than $15,000 a year and between 100,000 and 125,000. So now the decline in confidence is across the board, right? I mean, how many people earn less than 15,000 a year? And what would be their share in the consumer spending? Very little, right? And people who are between 100,000 and 125,000, again, that's probably not a big chunk, right? So that's a very important comment. And guys have to put this in perspective with what's happened in the past and why is it different this time. So I'm not going to go into too much detail here, but I'll just focus on two sections that I thought were quite interesting. So as you can see, this is the consumer confidence index. It's been going flat and now probably going to go much lower. So, and as you can see, whenever it's gone lower, and in the report it mentioned whenever the expectations index, which is not the confidence index, it's a component of the confidence index. Whenever the expectations index has gone below 80, that's been indicative of a recession coming, right? So as this confidence index comes down, you can see that the gray areas are basically periods of recessions, right? So if this keeps going much lower, we're going to be pricing in recessionary situations a lot more in markets, right? And what you've seen so far, it's basically been the start of, people anticipating that things could get much worse from here. Do we have any questions here? No questions? Okay, so let's focus on two segments here. So more than half of consumers expected higher interest rates over the next 12 months. This is a little bit different from what the market expectation is on interest rates, right? And that's predominantly because a lot of people are feeling a resurgence in inflation and, becoming a lot more fearful about the future prospects of inflation being higher. So the proportion of consumers anticipating a recession over the next 12 months increased to a 9-month high, right? So think about it. If you're expecting a recession, are you going to go buy a new car? Are you going to go take new debt? Are you going to go make discretionary purchases? Unlikely, right? Only 46.8% of consumers expected stock prices to increase over the year, the smallest share since April 2024. Fine. On the other hand, buying plans for cars and big ticket items were down, with notable declines for TV and electronics. Does that make sense? So, do you guys now see why automation is down so much? It's not just random. So, automation went from 197 straight down to 160. That's quite a move, right? And if you were to look at companies that sell home electronics like Whirlpool and so on, which we can look at now, I'm not expecting this to make new highs, right? So these companies are under significant pressure because demand is going to get much lower. So look at this, right? In towards the end of January, this was trading at 134. Now it's trading at 90.98, right? So it was attempting a recovery and then it just gave it all back. And now it's close to its all-time lows. Again, I'm not suggesting you go short it, but understand exactly what's happening in the market, right? There are so many good trade ideas if you just know where to focus and if you decide to take it to the next stage where you start digging deeper a little bit and then finding a couple of ideas exposed to these themes. And then finally, um, personal and healthcare, as well as movies and live entertainment, moved up the priority list, right? So people are still willing to spend money on these things at the expense of streaming and travel. Vacation plans continue to trend downwards. So that in itself is another theme that you could look into. I wanted to see what's happened to Netflix. Okay, so it hasn't corrected that badly. But there are other streaming services other than Netflix, so you could look at that. Vacation plans are trending downwards. We all know that the airlines have just been performing really badly. If you look at, let's say, American Airlines, look at this, look at the price action. So there's another contributing factor here in that the US government is kind of cutting its travel budget. So American Airlines would have been a big beneficiary of that budget. So with that gone, of course, it's reduced revenue expectations. But that's not the only story, right? So if you look at the airlines, I'm pretty sure, even if we look at the smaller ones like Spirit, is it still listed? I think it's been acquired. Yeah, I think it's been acquired. Let's find another one. Um, Give me a name if anyone knows.
Delta, Alaska.
Yeah, Delta. Delta is not that. It's not like that cheap. Okay, you can see the price action here, right? Technically broken. So managed to recover after so many years and then gave it all back in like 5 weeks, right? It's pretty drastic. And at the same time, you've got the oil price that's coming down too. Tala, do you have a question? Go ahead.
Roshan, I was looking at Southwest because I saw the sector, the airlines, and it had gone down a lot in the last 1 month. So I was looking
Mhm.
at check LUV,
LU
LUV, yeah,
LUV, right?
yeah,
Yeah.
Southwest. So
Okay.
they
So
seem to be
this is,
doing better than others.
yeah,
Then I
this
was
is
like, okay,
holding up a
I'll just
bit.
check. Oh, yeah.
Mm.
So I just marked it to just dig deeper what's going on here.
Yeah.
Maybe this could be a short.
Yeah, I mean this is probably a good one to look at. Um, but I would suspect if you look at all these airlines, this is probably one of the best in terms of return on equity and so on. So if you wanted to go short this theme, maybe the others would be better. This is like 18 billion. American Airlines is 7 billion. What about Boeing? Could also be another good trade idea, especially if there's resolution of conflicts, because it also manufactures some military equipment, right? You could also look at bookings.com. If people are going to be traveling less or spending less on travel, so it might be difficult for companies like booking.com to meet their earnings projections. So you have to be a bit careful because these guys have both individual and corporates as their client. And the corporate spending can be quite resilient, although if we have a recession, both of them would just go. So quite a few good ideas for you guys to start looking into. Uh, you could even look at entertainment parks. I was looking at Disney yesterday. Go ahead, Amin.
So I was looking at the airlines yesterday as well,
Mm-hmm.
and I was thinking that I wasn't sure whether there was still room for a short there because as we've seen, like a lot of them have already gone down by a
Yeah, yeah,
lot.
yeah.
I was
It's
looking also
moved.
at Alaska, etc. So
Yeah.
it's I wasn't sure if there is still room to go short.
It's moved a lot, and I think you also have the risk now of, let's say, oil price going lower and then them being able to manage their margins and so on. So maybe wait for a rally if you want to go short there, but pick a company that's terrible, right? Has debt, has a lot of issues, because then whenever the selling pressure comes back, they are going to be the first to be thrown out of the way. So look at Disney, right? Despite the rally, it's still below the 200-day moving average. This is a very good sign of a company that's probably going to go much lower. So my
Disney also has a streaming service, right, Roshan?
streaming service, parks,
Yeah.
basically combination of everything we want to be short. And it's also quite expensive, right? It's not like a cheap entrance to the park. So think about it.
Right.
Maybe it's discretionary. I don't know, right? Because people think about these things as a cult, right? Like, I'm not gonna buy dinner tonight, but we're all going to Disneyland. If you have that kind of a fan base, it's difficult, right? But I don't think this is gonna survive if we have a consumer spending crunch. And you can see, right? It's not just yesterday that the stock has started cracking. It's gone down from a long time ago. Basically, it's not able to compete with Netflix. So
Mhm.
go ahead, Amin. If I were to plot Netflix against this, yeah, go ahead, Amin.
Yeah, I was looking at this in light of the. If you go back to the report, I think the one of the last comments was saying that the entertainment sector is expected to go up.
Yeah,
So,
live
but travel
entertainment.
would go down. Yes. So
Yeah,
back to our discussion yesterday.
yeah.
Would the theme park would it be a good idea to also look at like the one I shared yesterday is called FUN, and there is another one, America Parks. I forgot the ticker name, but let me check it again.
But the thing is, you're looking at this as a long.
Yeah, I was thinking maybe long, not going long now, but maybe keep it, in the watch list for later.
Yeah, I mean, uh, I would probably be long only as a hedge, maybe for my shorts on these names, because all of these are just gonna go. If is it PRK, Park National Corporation?
Yes, PRKS.
Oh, okay, so you've got the other one, yeah. So all of these companies will just fall as consumer sentiment keeps falling. Yeah, cruise companies as well. I'm short Carnival, by the way. Carnival Cruise Corporation. It's reporting this week, I think on Thursday. PRKS, right? So
Yes, PRKS.
yeah,
Yes.
United Parks. Yeah. Yeah, Kitty is
Yeah.
just woken up now. Look at this. He came out of nowhere, just jump on my table. Um, yeah, so this is yeah, there's not much of a historical price data here. But yeah, I mean, this is 2.62 billion market cap. So you'd have to do a bit more work to understand, you know, whether it's a short or not. But you can see, right, these reports are giving you actionable themes that you could look into.
Roshan, along the same lines, I was looking at Peloton. I don't know if you had a look at it recently.
Yeah, I did look at it. I was looking at it as a long.
I was looking at it at short as well yesterday.
Yeah,
It gave up a lot of their profits.
yeah. So I was looking at it as a long around $8. I think somewhere here. When was that? November, December? Yeah, that's when I was sorry. Um yeah, but these companies are gonna find it very difficult if we go into a risk-off environment. So if you want to go long or short this, if you want to go long this company, you really need to do your work and understand
I
why the
was actually
market
thinking
will.
of it as a short.
Okay.
Yeah,
Mm.
it's mainly because of its depth
No,
and just
I think you can get better shorts.
okay.
Uh, there's no point getting into, like, let's look at this, right? Technically, it's held the 200-day moving average, right? And then
Yes.
if you look at, let's say, a company like Disney, which is comfortably below the 200-day moving average, what's the
Yeah.
market telling you here?
It's ready to give benefit of a doubt for
Exactly.
Peloton.
So
Yeah.
on Friday, the market had a chance to rally. Everything had a chance to rally. And
Yes.
it decided that it would not buy Disney
Mhm.
and it would buy a company like Peloton, right? So if you look at the
Yes.
daily price action, I'm sure it was massive on Friday,
Yes,
like 16%,
60%.
right?
Yeah.
So of course there's a lot of short covering and everything in the whole story, but just very quickly for you to get a sense of what the market is doing, and how are individual people looking at these situations and making decisions. The market had a big rally on Friday, right?
Yeah.
Disney is up 1.8%, right?
Yes.
So what is this telling you? People keep selling, right? Even if this is going down. And
Yeah.
especially Disney is such a large cap, so many funds own it. So all the funds that are, you know, it's literally like someone step on their neck, right?
Mm.
These
Yeah.
guys are just selling, and I think this has a much better uh, chance of being a good short versus the others. So
I think
Right.
Peloton as well. They were because I was looking at it, unless I'm mistaking it with another stock, but they were cutting costs a lot.
mm,
They were counting on
yeah,
that to
so
improve their margins.
so Peloton is in a turnaround, right? It's already experienced a lot of pain.
Yes.
For the
It has
last two,
from a
3 years,
long time.
it's gone from. I remember shorting it around 70, if memory
Okay.
serves right. Now it's
Yeah.
like $7, right?
Mhm.
So are you gonna bet it's gonna go from 7 to 3 to 0? If you have a clear case, yeah. But otherwise, I think it's best left alone, and bottom pickers are gonna come and try to find a bargain there. Looks like bottom pickers are all over Disney, given its popularity. Actually, no, I think bottom pickers are even staying away from that. you know, uh, it's down on the week. It's down big on on the last 2 weeks, and this is probably going to go back to 85. I think easily could go to let's say 90, and then 85. So do some work on this, understand what the stock trades on. Earnings is in 52 days. Between now and earnings, you can already have a good trade and get out without any earnings risk. Or if you feel very strongly about your trade, you can take earnings risk and then go for gold. So this is the way to look at these situations. Of course, don't just buy and sell on the basis of a chart, right? I'm looking at this. I know exactly why I'm looking at this, right? When I'm looking at the price action and I'm telling you, you know, this is like a technical failure. This is not like the first chart that I'm looking that's like this, right? I'll share a few more with you. Sorry. It doesn't matter if we stray away from the presentation. I think whatever gives you value is gonna make sense, right? So look at this. This is a bank. Technical failure again. It's closed below the 200-day moving average. Now, will this kind of try to go back and hug it back and all? Of course. But could this go much lower from here? I think it could, right? There are many charts that you'll see like this where the price was unable to go back above the 200-day moving average. Bhavan, you wanted to say something?
Uh, yeah. So for banks, I realized something that they are less volatile than other stocks. What I was looking at, especially the Canadian banks.
They are
Do you
what?
have any
They are what?
less volatile? Their price action is less volatile.
That's even better.
Uh, mhm.
It
Yeah.
means that there's a lot of consensus. People don't really look at this, and they just it's mainly institutional funds buying every month. And when there is going to be a news event, it's just going to go like 20, 30, 50% in one day. If there is such
Yes.
an event that's going to happen.
The Canadian banks are the main most of the market cap like of Canadian stock market.
Uh-huh.
So there might be a lot of institutional ownership who's trying to
Absolutely.
be
All
part
the
of
guys who
Canadian
are
economy.
holding these indices, uh, that's probably where they're going to go. So either directly or indirectly, people own this through an ETF, through index, through some funds. So I was looking at this Royal Bank of Canada. It's been able to rally above this, but it doesn't mean that the bearish thesis is ruled out. Also, the way to think about it, Bhavan, is historical volatility is great because your options prices will be based on that, right? But
Mm.
your job is to assess future volatility. If there is like a big GDP slowdown, even recession in Canada, there's no way that the banks will not react. The share prices, that is, right?
Yeah,
So you're anticipating these big market moves ahead of time, and you're buying options at that are priced at low historical volatility. So you get in cheap, which allows you to buy hundreds, if not thousands, of contracts, and then you sit tight. As the economy is falling in Canada, which it will inevitably, then the banks will just sell off.
100%.
Right? Right?
Yeah.
So,
And Roshan, for Canadian banks,
mhm.
sorry, I'm asking one more question. For Canadian bank, like, is there any equivalent, the term premium in number that we can look at similar to?
I haven't looked into this. Um, I can probably find out. There must be an index or something.
Mhm.
But think about it. You can even use the US as a proxy, right? So Canada is maybe one or two cuts ahead of the US, right?
Yes.
What happens when you cut interest rate? Term premium goes down.
Okay. Does it necessarily though? Because we can still keep the same spread, right? No?
Not really. Uh, Typically, what would happen is, let me show you by as an example. So, when was the US cutting rates?
2022 June.
Okay, let's look at. Okay, maybe this is not a good example, but let's look at 20. Okay, when did they start cutting rates? 2008, right? Yeah, somewhere here, right? So look at this. This uh, anyway, this whole range over here, this is 2008, right? If you draw a box here, right? Would you say term premium has gone up or down?
Trending down.
And you know that they've been cutting rates throughout, right? Of course, there's been moves up and down, right?
Mm.
But the general trend is lower. And as they cut, when it's like a fresh cut, it typically goes down a lot. We are concerned with the rate of change, not the actual absolute amount itself or level, right?
Okay.
So my guess would be, as they are cutting rates and they are further ahead of the US, that their term premium would be lower or going lower much quicker.
Mhm.
You can also do a bit of work in terms of how term premium is calculated. There must be something on the internet and work it out yourself. If there is not like a publicly available index for this. Let's
Yeah.
actually look for this very quickly. Okay, term premium. Yeah, but this is the US. Anyway, I'll look for it later, and then I'll let you know if I find anything that's usable as a proxy. Okay.
Okay.
So yeah, my whole point was in this market. So basically, let me ask you this, right? Feel free to unmute and just give me your thoughts. What are the questions that you're asking yourself at the moment? When you look at the market, 4 days in a row, it's sold off. Then on Friday, there's a steep recovery. What are the questions that come to your mind as you're deciding what's your next move going to be in the market?
For me, it's more like, is the correction over, or
Hmm.
are we just having like people covering shorts or something like that?
Yeah. So your main thought is, if I go short, would I get caught out by the rally?
Yes.
Right? Am I like the greatest fool here to be short a stock and then on Monday it's just going to rip 5-10% in my face? Right?
Yeah, that's exactly.
And if you go long, what are the questions that you're asking yourself? If I say, okay, Hans, give me 5 long ideas and I want you to put that in the portfolio, what are the questions that immediately come in your head?
Yeah. Is the correction over?
Exactly.
Is the
So so you're so you immediately ask yourself, uh, again, am I the greater fool here that I will go long this company? And then on Monday, the market will open 5% lower. And now I'm just going to be staring at my position like in the red. So
yeah.
whether you go long or short, you have the same question, right? But the thing is, it doesn't matter where the S&P, what the S&P is doing, right? You've got sectoral biases, which I've just mentioned to you: travel, airlines, uh, your booking.com companies. If you can find a company that manufactures, I don't think Samsonite is listed in the US. I think it's a European listing. Yeah. But if you can find companies that, let's say, people buy luggage or, all these travel accessories, and there's a company that has high exposure to travel accessories, do you really care where the S&P will be on Monday, Tuesday, or are you just going to go short that company once you've done your thesis and you can see it's going to miss earnings,
I'll probably be shorting it.
right? Like
Yeah.
Airbnb, if fewer people are going to be traveling, do you really care where the Nasdaq or the S&P is, or what it's going to do by next Friday? Or are you just going to go short and take a bit of earnings risk, and because you've got high conviction that this company is on the wrong side of the fence, right?
Yeah.
So that's the whole point I'm trying to make, right? Uh, every time we are confused, it's because we are not looking at the right things, right? So it's a little bit like you're in a relationship, and then you wake up and you're like, how am I going to make this person turn from insane to saint, right? And
Yeah.
then you waste your entire day thinking about that. You're Googling, you're asking your friend, and you're like, help me, I need to turn this insane person into a saint. But then maybe the solution to that is to say, this is an impossible task, right? Insane people don't turn into saint. So if I want someone who fits, my relationship criteria better, the only solution here is to realize that this is the wrong person for me and to look for someone else, right? And it's the same with stocks, right? You're waiting for price action to confirm your view, which inevitably means if you're going short, you're going to be shorting the company at when it's making a new low, right? And then the next day you'll find yourself getting whipsawed, and now you start doubting yourself, and you're like, ah, the moment I pressed the button, the market went up, right?
Yeah.
And it's the same
We-
thing for longs as well. You're gonna go long a company, then the moment you press the button, you see it's down 2%, and you'll be like, the market is out to get me. But or it's even worse, right? Before you even get to that point, you're just looking at the S&P, it's moving up and down. You're looking at the VIX, you're looking at QQQ. Then the next instinct is to go to Google, find a couple of veterans who are 200-year-old cavemen, and you're expecting them to give you the answers to what's going to happen next. That's not what you should be doing. You should be looking for sectoral biases, themes that will still be strong over the next few months, still be weak over the next few months, go long, go short. Nothing's changed. The only thing that's changed is there's more volatility and the market is willing to give you more money. That's basically what's changed, right? Because if the market is willing to move a lot more, it's basically telling you if you participate and you're on the wrong side of the fence, you're going to make more money. So there needs to be a little bit of a perspective shift in that we shouldn't be fearful of these massive moves. Rather, we should embrace it and say, okay, the ideas I wanted to go long, I'm getting them cheaper. The ideas I wanted to go short are moving a lot more, which means that I can put in my shorts, and they're likely to work in the next 2-3 weeks. I don't have to wait for 3 months for them to work. That's basically what you should be telling yourself. Does that make sense?
Yes, you should use volatility.
So yeah, I mean the analogy about the relationship is also true, right?
Yeah,
Sometimes you've just got to figure out that you're asking the wrong questions, right? If you cannot find answers to the question, maybe the question is wrong. Yeah. If you spend your whole day obsessing about why is it that I don't have wings and I cannot fly, you'll never find the answer to that, right? All that you'll get is, just wasting your time banging your head and still ending up with no answers. So the question you're asking is wrong. Okay, let's carry on. So the reason I'm focusing so much on confidence, on consumer confidence, is because it's 70% of US GDP is consumer spending. So I think what's happened is a consumer, the US consumers have been resilient for a long time. And I think they've had enough of this whole inflation thing. It's gone on for far too long. It's almost like, the US government and the corporates are just showing a middle finger to the US consumer. I think that's basically how I would feel if I was in the US, like out of nowhere, prices of eggs are going through the roof. Everything is just like, we're getting sticky inflation. We need to celebrate when we have like a 3.1% CPI print. What's there to celebrate, right? After such a massive, prolonged period of inflation, you still have inflation sticky at 3.1%. That's a crime. Okay, renting over. Let's get back to this. So for the next 6 months, the chart on the left is basically showing you that fewer people are expecting that the family financial situation will be better, and more people are, of course, feeling that it's going to get worse. So once again, if you're going to be making large discretionary purchases, this is the conversation that's happening within families, within people's head, and it's going to be more and more difficult to convince people to make that discretionary purchase from here. On the right, we've got the perceived likelihood of consumers' perceived likelihood of a recession over the next 12 months. So that's going up, and I think it's going to keep going up as the market comes down. I have a slide later on. Okay, there it is. So these charts are taken from the Michigan University of Michigan Consumer Sentiment Report. So the blue line is the moving average, the dotted line are the monthly data prints, right? So the current value of stock market investments, so respondents indicated that these have come down. Of course, as the market is selling off, you'd expect them to say that their stock market investments are going down. But what's important to note here is you would remember last week we discussed about the wealth effect, right? So if the market comes down further, is there a situation where uh, is there a situation where sorry, I lost my trail of thought. So if the market comes down lower, is there a situation where the wealth effect is totally gone and now even the rich guys are curtailing on their purchases? I think that's very much likely. And the rich guys would tend to be the baby boomers who have just retired or have retired already. So these guys don't necessarily have active opportunities to make money, right? They have a lot of investments and they get dividends. They are living off these investments. But if these investments are going down in value, I think you can understand why these guys would be a lot more pressured, right? So they're going to be thinking about purchases very differently. And again, who are the people who predominantly book cruises? It's the baby boomers, right? So this is basically what I was thinking as I was going into the Carnival short. So my expectation is that as we go along in the next few quarters, we'll see that estimates get revised much lower, and we might also see people asking for refunds. So a lot of these cruises, they sell advanced bookings, and it's possible that we could see that people start canceling their cruises, and that Carnival has to issue refunds. So the situation with Carnival, if you have dug deeper, it's quite interesting. They use the advanced booking as cash flow. So they fuel their cash flow their operations with these cash flows. So, and they are very transparent about it too. They definitely say that they use this as a form of capital or working capital. And you can imagine what that's gonna do if they start having a lot of cancellations, and now they have to take money from their pockets and give it back to customers. So Carnival Corporation is a company with a lot of debt. Cash flow metrics and all of these are not the best. And if there is any slight change in booking habits or behaviors, I think they could be in a lot of pain. So that was kind of my reasoning here. Bhavan, I'm just going to read your comment here. The US consumer is the selling point for the admin when slapping the companies. Absolutely. However, now that the consumer sentiment coming down and spending likely, US might be losing. Yeah, I mean, Trump is saying that he's okay to take some short-term pain, but I think I think I've said this before, right? He's playing with fire on many fronts. Um, I don't know how this will end. If you ask me about my views on tariffs, eventually any form of government intervention tends to make capitalism take a few steps backwards. What does that mean? The industries that are protected by government in one way or the other, whether that's subsidies, whether that's through um, tariffs, which basically prevent foreign goods from competing on the same level, all of these are anti-capitalistic in the sense that these industries will not have the same um incentives to innovate and to produce the best products at the best cost structure, right? So I think in the long run, what will happen is if these tariffs are implemented and if these industries become too reliant on these tariffs as a form of protectionism, the quality of these industries will go lower. So management will get worse. Investors will get worse returns. And eventually, what would happen is one day or the other, tariffs will go out of the window, and then we'll be back to square one. So all of this is not positive in any way or form. Sure, he's thinking that he's going to create jobs and all, but think about it. There needs to be massive investments before the jobs are created. Even for the jobs, you need massive skilling, right? Sure, you can use robots in many cases, but it's not going to be possible for everything. And I think, doing it in an experimental manner on such a large scale is taking a little bit of a gamble here. But yeah, who am I to say anything, right? That's for him to decide. It's his government, his country. Let's move on. Expected change in business conditions in a year. So that's heading lower. And, if business conditions are expected to go lower, I think by extension, that also means that consumers are not expecting the job market to be thriving. So keep in mind that all of these are expectations about the future. It's not the current conditions. This graph was quite interesting. So it shows three things in one graph, actually four things. So one is the sentiment by all consumers, and then sentiment across these different metrics by independents. So neither Republicans nor Democrats. The first metric is unemployment over the prospect of unemployment over the next 1 year. There is consensus that this is going to get worse. So unemployment is going to get higher. Inflation expectations over the next 1 year. I mean, even I'm shocked because I think in December, if I'm not mistaken, the expectations for inflation going out 1 year was 3.3%. Then in January, it was 4.3%. So I did highlight this and I was quite shocked when I saw this. And then on Friday, that number came to 4.9%. So whatever the Fed might be saying with inflation being under control or coming down and all, the consumers are saying, you've got your feet on my neck. I cannot breathe. This is stifling and I expect it to get even worse. So that's basically what the consumers are saying. And if you were to look at these indices, you would see that even the Republicans now are heading lower. So, of course, Democrats were low going into the elections. The Republicans were optimistic, but now in the last few reports, you've seen the Republicans now also head lower. So it's basically consensus across the board now that expectations of the future are worsening. Another thing, the Fed does mention consumers' expectations of inflation over the next 1 year. So they do have an eye on this. And keep this in mind whenever you're betting that the Fed will cut rates. Because they will look at this and look at how inflation has performed and they'll say, I think we can wait. There's no reason for us to cut rates prematurely. The Fed will meet this week. So keep an eye on what they say. I'm pretty sure they're going to stay hawkish. There's no room to be dovish here. That's my view anyway. The other question I had in my mind is inflation cooling? Because if we look at the indices, whether it's core CPI, CPI, PCE, and so on, they all seem to indicate that the CPI index is cooling, right? If you look at the graph, it's undeniable that it's gone much lower. The question is this going to make a new low? And then inflation is going to head back into the 2% range? Or is this going to stay sticky around 3% or even move higher? So far, we can see that the trend is down, but the question is this going to be sticky? Okay. So what I've got here is the core CPI index. So this is all items less food and energy. What I've got here is basically all the metrics of inflation, CPI and PCE, right? The Fed looks at PCE, but we look at both of them, right? And then I've got these two indices plotted against a rental index. So if we start at the top, basically the graph you're looking at is PCE rent component plotted against CPI rent component. And you can see both of them are moving in the same direction. It's almost like a mirror image, right? So basically, what this is saying is there's not a discrepancy between how CPI measures rent and how PCE measures rent, right? The second graph is a graph of CPI with the rent of primary residence index versus CPI owners equivalent rental index. So again, that's trying to show you that there's not much of a discrepancy between the way rent is being calculated between these two indices. The reason we're looking at this is because in the past, there was a little bit of discrepancy. As you can see, when there are big changes in the rental index, then because these things measure different things, for a number of months, they don't necessarily agree, but eventually they all converge, right? And then lastly, we've got so that's the Zillow rental index. So this is Zillow is basically like a property portal, and it's measuring the rental index, and it's a lot more high frequency than the other indices or the other measures of rent in the CPI or the PCE, because it's actual listings that are happening, right? So as an example, in the UK, you'd have Rightmove as an equivalent of Zillow. In the UAE, you've got Property Finder or whatever. In South Africa, you've got Property 24. So these are all these property portals where you'd go if you needed to rent a property. So basically, this is plotted against the new tenant index. Yeah, this is plotted against the new tenant index. So the reason we're looking at this is because shelter is a big component of CPI and PCE. And we can see across all these measures that they are going down, right? Which would by extension mean that CPI would be heading downwards in the next few months. However, or actually, to contribute to that view, we have to ask ourselves if there's going to be further deterioration or deceleration in the rental index as the US starts deporting more and more illegal immigrants, right? Because that could increase the supply of properties that are available for rent. So keep that in mind and keep an eye on these indices, because this will have a big factor on the CPI index at the end of the day. Now let's look at the PCE. Again, it does indicate that we're seeing a bit of a cooling off trend. There's been a bit of a sticky few months, but now it looks like we're headed lower. Still, we don't have confirmation. If we look at the year-over-year index, we had a bit of resurgence, and now the last print that we got was headed lower. Same for the core PCE. So now the question is, does this make a new low, or is this just going to bounce around or even go higher? So I still think inflation is a bit sticky, and it probably will take a bit longer to deal with. If you look at the same indices on a month-on-month basis, you can see that it's gone up from the last month, right? So not much to read from the month-on-month movements, because these are quite volatile. But keep these in mind, right? Because on a yearly basis, this is going down, but on a monthly basis, it doesn't look like it's going down. If anything, it's flat or even going higher. And then finally, this is where we get more interested. So we move from the coincident indicator to the leading indicator of inflation. So coincident indicators tell you exactly what inflation is doing now, whereas the leading indicators give you an insight into what the inflation would be doing in the future. So we've already seen that the consumers are expecting much worse inflation rates in the future, right? Now, let's look at what these actual indices, which are leading indicators of inflation, telling us. We're looking at the US PPI on the left. So it's consistently going up, and the last print has been lower than the last few months, but it's by no means going lower, right? So the trend is still up. In other words, what this means is US producers are paying higher for their raw materials, and eventually we would expect these to be passed on to the consumers in one way or the other. On the right, we've got the same index, excluding food, energy, and trade services. So this is a bit like a US core PPI index. This one shows that maybe we're seeing a little bit of deceleration in the PPI, but again, it's still above 3%, right? So, from my perspective, inflation is not yet under control. There's still a bit of risk that this remains as sticky. The worst risk is that employment starts falling and inflation stays up, right? Because that would put us in a stagflationary environment, which is not good for risk assets like equities. Let's move on to the ISM manufacturing and ISM services reports. So this is basically the purchasing managers of the largest companies in the US on both manufacturing and services um, that are telling us that they are paying higher prices for their raw materials, right? Not just higher prices, but every month the prices are going up. So my view is that what we'll see in the PPI is that these numbers will start either going higher or, staying high but moving sideways, and that eventually this will feed through to the CPI. So the CPI might not go much higher, but what could happen is it could stay in the region of 3 to 3.5%. So it stays sticky, and the Fed has no way to get it further lower, right? So unless we have a recession, I think this is probably what's going to happen. There's also been a lot of comments about companies anticipating tariffs and then increasing prices already. So even before the tariffs are announced, a lot of companies are already increasing their prices. That's a little bit of an issue because, as we know with Trump, he tends to flip-flop. And as he's pushing these numbers out there, companies are already responding. So they're already putting prices up in anticipation of that. There are very few instances where people or companies reduce prices. A recession is one of them, but typically when prices go up, it's very difficult to get them down because, the whole cost structure is already adjusted to a higher level. At the same time, we're also seeing some comments around labor costs that are also on the rise. This is even more concerning because labor cost tends to be a bit more long term and a bit more sticky in terms of inflation. Think about it, right? It's very rare that um, you haven't gotten an increase in your salary, right? It's very rare that you go meet with your employer and he says, look, inflation was down last year, so I'm going to cut your salary. That doesn't happen. Wages just keep going up, right? And if wages have gone up last year and it keeps going up next year, people spend more money into the economy, raising prices even higher, and that just keeps inflation going much higher. So it's a long-term inflationary pressure. And finally, just to leave you with some actionable thoughts and trade ideas. So we all know that the government is cracking down on its spending. So there is this. I've got the link below. You can check it out on your own. This came out in February. So the government has basically asked a lot of their agencies to look at all the contractors that they are using and start canceling contracts with them. For any contracts that they still want to keep, then a senior official needs to sign and verify that such contract is mission critical and provides substantive technical support, right? So you can see what's going on here. You can feel free to unmute now. This is the last slide of the presentation. So they are putting a lot of pressure on the government employees to justify why they are using certain contractors. It's always baffled me why you have so many government employees and then you still need contractors. It should be one way or the other. Either you use contractors or you use government employees. But to have a mix of the two is a bit of a problem. And South Africa is a brilliant example of this. Some people who work for the government are also contractors for the government. So the corruption is just crazy in South Africa. And you have like the electricity provider that's called Eskom. So it has, I think it has 60% or something. Don't quote me on this. I cannot remember. It's been a long time. But it has a high percentage of its employees that are also contractors with the government, with Eskom. And it's no wonder that, every now and then they keep having electricity cuts because they cannot produce electricity. The infrastructure has gone to dogs, and it's just a very very sad state for for the country. Let's come back to this now, right? So these are the firms that were included. These are the 10 top firms, the GSA administrators. Um, a lot of them are listed. So you've got Accenture, that's listed. You've got Booz Allen Hamilton, that's also listed. You've got Leidos, that's listed. You've got Psych, that's listed. You've also got CDW. I mentioned this last week. So they have a big portion of their revenue that comes from government contracts. So, guys, get digging. There's a lot of gems that I'm dropping here, a lot of tradable ideas, and as usual, a lot of money to be made on these trades. I'm sure General Dynamics is also listed. I probably just didn't look at it. Okay, do we have any questions? That's the end of the presentation. Feel free to unmute, share your views, ask your questions. Don't be shy.
Yeah, Roshan, like, do you have a view on how much the government is going to be able to cut down on these contracts? Like, what are the metrics you're looking at?
Look,
The portion of government revenue?
I don't have a view on this, but it's fairly clear that, look, think about it. If you're a manager and then you work for the government and they ask you to justify and put your signature to justify the presence of a contractor, you're more likely to cover your own ass than to fight for a third party contractor to stay on a contract, right? So if anything is not mission critical, then why would you justify their presence or their existence? You would be more incentivized to side with the government and to try to crack down also and show that you're helping with this whole cost cutting exercise, right? Who's going to come and say, yeah, we really need Accenture on this product, on this project, when Accenture is basically maybe just building like a database for them or doing some stupid basic IT thing? There are big projects where you still need Accenture, but they also get involved in very trivial projects, right? So a lot of these companies will have pain. Look at Accenture, look at the way it's trading. I think it's reporting next week, 20th of March. Yeah. So look at Accenture. It's not in the best of shapes, right? Once again, it's closed properly below the 200-day moving average. So let's say you get a pop here. You can prepare yourself for earnings and everything. Make sure you understand the business, and maybe this rallies into earnings. But then if you think that earnings is bearish, you can always put the trade on. With these things, Bhavan, it's not a question of having the exact answers to the magnitude of things. It's a question of understanding the direction and whether this will make a big difference to the company or not. So if, let's say, Accenture has 0.5% of revenue exposure to government contracts and 0.1% of this is actually cut, right? You're not going to be uh, too concerned about this. Yeah?
Yeah. Yeah, that's right.
Can you still hear me?
Yeah, I hear you.
Sorry about that. I think my HDMI cable was loose. You can still hear me, right?
Yeah, we were hearing you
So
throughout.
what I was saying is, if the company has a very low exposure to government contracts, and 10% of these contracts are killed, it probably doesn't matter that much. It's going to be able to recover from other means. But with Accenture, think about it, right? A lot of this AI stuff, they are not at the forefront of innovation. They're still getting a lot of contracts, but they are not at the forefront of AI workflows and all of this. So I think there's a bit of downside potential for companies like this. I was looking at this feature in Coifin. Just bear with me for 1 second. There is this feature in Coifin. I think it's available only for the paid versions, where you can search through transcripts of companies. Yeah? So you can put a filter and say, okay, I only want, let's say, companies that are in the S&P 500, right? And then you'll get all these transcripts where government contracts were mentioned. So sometimes it can be government contracts, other times it can be federal contracts, right? So these are the two keywords to be using. And then from here onwards, you can find your company that's exposed. So it's much quicker than actually looking through 500 companies and figuring out which ones have exposure to government contracts. You've ever used this before?
Yeah, I was looking for aluminium before. Same,
Yeah.
same thing.
Yeah. So you can use it for various purposes, you know. You can even limit it by sectors, so you don't get a lot of reports to go through. So I was looking at WEX yesterday. Um, yeah. So they were talking about contract negotiation. Uh, and then a lot of times, just by the way management addresses the question. So from a government perspective, it's less than 1% of revenue, which means that you would not be too concerned about this company losing out, right? So we do business with the federal government with our fleet, but really a small part of our portfolio. Yeah, you can see this company is actually getting a lot of. So the government has come back to it. So I can start by observing that we had two contracts show up on the Doge board. One of them was for a contract that had already added, and the other was for a contract that's about to end, had about 1 million of revenue in the current year. A week or two later, government issued a list of top GSA contractors, which did not include us, I'm happy to say, in that top 10. Okay, so they don't see themselves at risk or at big risk of further cancellations. But you know, you just read it, you'll get a very good gist of what the government is doing to these companies. And it might be this company or it might be something else, right? And if you just read this, and the security business with the federal government, we define as Department of Defense, the 18 intelligence agencies that are in the intelligence community, where we have a very large presence with customs and border patrol in particular. So I don't mean to minimize the attention we're paying to this, but our exposure to the areas of that government seems to be particularly focused on is quite small. So it seems that if you're part of defense, homeland security and all, it's a bit more mission critical, right? As opposed to, let's say, if you're building a road for the government or, you know, there are contractors that basically are involved in document retention, document destruction, and so on. One could say that this is highly mission critical, but another person could say that this is absolute crap, that the government can take care of this themselves. So this is a theme that you can explore on your own and figure out which way you interpret it. And, you know, for instance, if we do CW, and doing these exercises, guys, help you to improve your knowledge base of companies and all these interlink that you've got between companies and government sectors and so on. So the more research you do, the better you get for later. And you never lose by doing more research. You only lose by, looking at the media and trying to get answers from the media. The media is not there to give you answers. The media is there to make you click and then generate advertising spend. You should realize this by now, right? Same for YouTube. YouTube is not there to educate you. It's there to get your attention and then show you some ads and generate ad revenue from that perspective. Okay, there it is. So net sales by channel. Uh, these guys, they get 613 million from government. No, actually, it's even more, right? Total public is, yeah, this is how you read this. Total public is 1.8 billion out of 5 billion total revenue, right? So what's
This is
that?
1 quarter only. I think if you look at the annual one, is 2 billion, right?
No, I think 2 billion is the change. You could look at here. This is year ended 2024, right? 2 billion was the change. I mean, not the total revenue. So, on an annual basis, the total revenue from government is 8 billion versus 21 billion of revenue. That's more than 30%, 35%, yeah. So, what was that? 8. So 8.2. 8.2 divided by 21. 39%, right? Of revenue that's coming from government. So there's big risk of these numbers being chopped. And if you look at the earnings profile of this company, it's not like it's doing fantastically well. So you look at the share price, you're not early to this trend here. But could this go lower? Probably. If this rallies even further, if it goes maybe somewhere here, like back to 180 and so on, that's probably where I'll be shorting it again. Okay, so I'll pause here. If you have any questions, feel free to unmute. We've got maybe a couple more minutes and then we'll have to stop the call. So yeah, fire away. If you got any questions, go for it.
Maybe Roshan, so this is the last webinar of this series.
Yeah, that's. I think we can still have one next week. And then that's going to be the last one because I'm going to be on holidays. So I only come back maybe mid of April, and then I'll still be kind of in holiday mode. So maybe by end of April, I'll be back properly to the desk. Would you guys miss me?
Of course.
Yeah.
No, I mean it's good to take a break as well, right? Whether it's this webinar or whether it's from the markets and everything else. I've been kind of having second thoughts in terms of, whether I'll still have positions on while I'm away or not. I still want to have a few trades in there because they're just too good to miss. But then, of course, I need to be careful because I'm not going to be able to monitor it that well. So I'm certainly reducing my exposure. Just thinking, how much to do over the next few weeks. So,
Hey,
do we
Roshan,
have
quick
any
question.
questions?
Yeah, quick question.
Yeah, go ahead.
Yeah, so what's your probability of having a bear market now? Is it getting more and more probable?
A bear market by definition is 20% correction from the
Yeah.
top, right?
Mm-hmm.
So I think now we've done I think at the peak, at the worst, it was 10%, if I'm not mistaken,
Hmm.
top to bottom. We're probably like 8, 9% now.
Okay.
Um, I don't know. But the thing is, by the time we're in a bear market, you know, it will become quite evident, right? You'll start hearing about recession and all of this. I don't,
Hmm.
I'm not, I'm not convinced that the rally will last. I can tell you this. Uh, I'm looking at things on much shorter term basis, you know?
Right.
I think there might be a bit of positive news around ceasefire and all of these things. But fundamentally, on an economic level, I don't see improvement. If anything, you know, I'm seeing a lot of worrying signs.
Hmm.
So I'm not saying we're headed to a bear market, but I'm certainly not seeing, you know, like a rally back to the top and resumption of the bull market in spectacular fashion. That's definitely not what I'm seeing. I think
Hmm.
we'll go much lower. That's my view at the moment.
Okay. Yeah, by the time you're on vacation or before.
Yeah. I think some of the names we've spoken about today, we'll come back
Hmm.
to this in a month's time, and many of you will be holding your head and saying, why did I not short this? I mean, you can see some things are quite obvious, right?
Hmm. But I guess in the next week we'll have more info, more confirmation on what's really happening in terms of retail sales,
Yeah, I think retail
housing
sales
market.
comes on Monday, right?
Right.
And
Hmm.
then the Fed will also be chipping in.
Yep.
Um, I think that's going to set the direction for markets.
That's
And
right.
I, yeah, I mean, I would not be surprised to see the sell-off continue on Monday.
Hmm.
You know, we
Yeah.
see
Yeah. And given. Hmm.
if you look at markets, right, on Friday, they basically just wiped out the losses made in the week
The
before,
prior day.
right?
Hmm.
It's not moved up, right? It's barely moved up, if anything. It's not a
Right.
recovery. It's just like, okay, maybe we were oversold and then some shorts got squeezed. And it's still got a lot to fight and show before we can, you know, get confirmation that this is actually recovering.
Hmm.
And the economic data will crack. I mean, you can see it. If U.S. consumer spending goes, it's very hard to have, you know, GDP go up and so on.